daily highs and lows. When you get this lesson, you're going to see there are setups every single day. Just know that being content with profitability early on in the week is ideal, and taking new setups late in the week, typically Thursday or Friday, after being profitable, this is going to be problematic for you because you think that you're going to be able to do this every single day when you're first developing, and that is a misunderstanding on your part because you're falling in love with the idea of winning and you're not falling in love with being process oriented. You like being right, and it doesn't matter how much money you're making. You are falling in love with the idea that you're correct, that you're better than everyone else. And that's going to be a trap for you. You think that you have to do this every single day, and it doesn't have to be done every single day. In the future, you're going to find a great deal of comfort by not taking trades. Right now, it feels uncomfortable to you. You don't feel like it's right to be outside of the marketplace. The markets are open, so therefore you should be in there trading. That's what you think right now. But you have not understood the potential risks that are involved in this yet. You're too fixated on the money. So you have to understand that when we understand the daily highs and lows offer the potential for draws on liquidity, and that means the market will likely go above old daily highs to reach for buy stops, or below old daily lows to reach for sell stops. Not every single day is the market providing that opportunity. Some days there's consolidation. Some days it doesn't even trade to the previous day's high or low, and you have an inside day. Other days you'll have an outside day, which is it's trading above the previous day's high and below the previous day's low. And you're going to learn there's a lot of things that are relatively significant when it comes to individual days that form like that. I've included the vertical lines that delineate each daily range. Now, when the market trades through multiple blue lines, it's indicating that it has strength to break old daily highs. And when the market trades down below old lows in the form of the red lines, it's showing willingness to go lower, and it's showing bearishness. Now, it seems obvious, but that's really not what I'm trying to get you to understand here. I want you to see how the market reacts once it trades below the red lines. If we are bullish and we think the market is likely to go higher, we want to see the market spend little time under the red lines, and then once it goes back above the red line, it needs to trade back through a blue line, at least. Because if it does that, the algorithm will change its state of delivery where it will no longer see a necessity to go lower for liquidity on the downside. It'll start to seek liquidity on the upside, and vice versa. If the market trades above the blue lines, which is an old high of some capacity, once it trades above that blue line, we want to see it not spend a lot of time there, then break down back below the blue line, and then seek a run below a red line, which is an old low. Then the delivery state will change from being bullish to bearish, and then the algorithm will then seek sell side liquidity, which is below an old low or below a new red line. What I just said to you, you're not going to pay attention to the first time you hear it. It won't mean anything to you until you start studying it, faking it like you have it, figured all out, but internally you're going to be dying inside. It's avoidable if you listen. If you look at these individual days, the vertical lines delineate those.
Wow, what you just learned here could change the whole approach to trading. Are you ready to take the next step? Your next big insight is just one click away.